Hi, everyone. Welcome to today's panel conversation. My name is Andy Saldana. I am the Executive Director of New York Tech Alliance. New York Tech Alliance is a nonprofit organization that works to create access and equity here within the New York Tech ecosystem. Before we begin, I just want to say a few quick thank you to all of our wonderful annual partners that make possible the work that we do. Everyone from Xander and CUNY to Information Builders, Paul Ellis Law Group, Verizon, Grasshopper, Google, EY, Crown Castle, Witham, Propeller, Nation Builder, full list here. You can find all of our partners on our website at nytech.org. Check them out. If you ever want to get connected to them, please let me know, and I will be more than happy to make those introductions. There are a few ways that you can support New York Tech Alliance during this time. The first is to add a donation when you RSVP for a virtual event. The second is to become an individual or corporate member of New York Tech Alliance on our website. Or the third is to simply make a small donation. And you can do all of that at nytech.org. We have a number of amazing events coming up for you in the next month. In addition to today's event. The next one on our agenda is Tuesday, October the 27th at noon. It's our next edition of our Founder Spotlight series done in partnership with Grasshopper Bank. We will be featuring Eni Lim, the CEO and co-founder of Honeybee. These are always great conversations, very casual. It's all about how they're making it work during this current time, how they built their business, and the things that they've learned along the way. It's facilitated by Miha Baldwin of Grasshopper Bank. Always a really fantastic conversation, and I hope you can join us. And then on Tuesday, November the 10th at 5:30 p.m. Is our next installment of our New York Tech Meetup. For November, we are doing a celebration of Black women founders in partnership with Black Women Talk Tech and GSD with Georgie. Both amazing organizations, and we're looking forward to a really fantastic program for that. So please join us on Tuesday, November 10th for a night of amazing demos from Black women founders. And then join us again on Friday, November the 20th for our next edition of Startup Financing Forum. During that conversation, we'll be focusing on M&A exits during these times. Paul will be right back with us leading that panel, and we will be putting together an amazing group of panelists to have that conversation. Again, thank you so much for joining us today. We have put together a really amazing panel of VCs in the ecosystem that will be led. The conversation will be led by Paul Ellis of Paul Ellis Law Group. I'm going to turn it over to him and let him take it away. Please also connect with me after the event during the networking piece at the tables. I'll be available at the New York Tech Alliance table. And Paul, please take it away.
All right. Very good. Andy, thank you very much. Welcome all. It's great to have such a good turnout and to have such a great panel today. So for those who have been paying attention to our events, they will recognize this has been part of this. This is part of a series. When the pandemic began, we had our first event back in April on what was happening in the VC financing scene as a result of the pandemic, what the impact was, how startups were being affected. Then we had, that was a VC event in April. In May, we had a similar event on angel financing. We had a panel on venture debt in May or June, and then took some time off, and now we're back again. So given that some time has passed and we have a better sense of what the world looks like, and maybe a little bit more what it could look like going forward, it seemed like the right time to come back and revisit. So we have a great panel together today to approach this topic. I think we can all recognize that things have, when we compare what things are now to where they were when we had this last event back in April, we do have a better sense of what things look like. The VC market has not tanked, as there was at least some fear. I mean, we didn't really know what was going to happen at that point. And according to Q3 data, by and large, the VC market has maintained relatively stable across funds, different sizes of rounds. But that high-level data masks, some developments in the early stage space that I think are important, especially for people who are here today on this panel. According to the NVCA, the National Venture Capital Association, the number of seed and early stage VC deals rapidly declined in the third quarter. So that is to say, even though there's a lot happening at the higher ends, there's a decline at the lower ends. That decline was even steeper for startups that were doing their first round of financing, reaching a 10-year low in the third quarter. And it was also pronounced for female-founded and Black and Latino-founded companies. So again, given the attendees today and the makeup of Tech Meetup, although the overall trend in the industry is good, there's weakness in areas which are of particular concern to this audience. So that's part of what we want to address today. So we have a great panel together today. We have Andrea Hippeau of Lerer Hippeau. We have Simeon Iheagwam of NOEMIS Ventures, and we have Erik Nordlander of GV. So we've been really pleased to get such a great group together. What we're going to do to start, we'll just go around quickly, everyone introduce themselves, say a little bit about their organizations, and then we will jump right into the content. So again, my name is Paul Ellis. When I'm not doing these events for Tech Alliance, I'm the managing partner of the Paul Ellis Law Group. We are a 9-lawyer firm in Midtown Manhattan. We do a lot of work with startup and early stage companies in financing, whether it's venture, angel, or friends and family, as well as mergers and acquisitions, formations, general operations, and the various other areas that are of concern to startup companies. Everyone in the firm comes out of top law schools and major New York firms, so we're able to offer sophisticated services with the more competitive cost structure and personalized attention of a boutique. We all do a lot of work with startup companies, so we're often able to make referrals and introductions to other service providers and investors that do a lot of work in the tech ecosystem. With that, I will turn it over to Andrea.
Oh, shoot, I don't know what happened to my video. It's just yellow, right, for you guys?
Yep.
Okay, let me do my intro and then I'll try to fix it when other people are going. Sorry you can't see me. Hopefully I'll be able to fix it in a minute, but my name's Andrea Hippeau. I'm a principal at Lerer Hippeau. We are the most active early stage investors in New York. So we typically do between 20 and 30 seed stage deals a year. We have about 250 active companies, about 60% of which are in New York. And we're generalists. So our portfolio is split pretty evenly between consumer and enterprise, about 60% consumer, 40% enterprise, and just really looking to back the best founders at the seed stage in New York.
All right, Andrea, thank you. Simeon?
Awesome. Thank you. Good afternoon, everyone. I'm Simeon Iheagwam, the founder and managing partner of NOEMIS Ventures. We are at early stage. We do pre-seed and seed stage investing in fintech, marketplaces, and companies that effectively use artificial intelligence and machine learning. We're based here in New York and have been operating for about 3.5 years now. Thank you for having me. Look forward to meeting everyone.
Thank you, Simeon. Erik?
Hey everyone, great to be with you. I'm Erik Nordlander, general partner at GV. I lead our New York office. GV is Google's venture fund, but we're an independent arm. So we are financially motivated and invest in things that are, good for Google, bad for Google, independent of Google. It's all fine. We tend to invest everywhere from seed to pre-IPO across a number of different areas: consumer internet, enterprise, health and life science, and frontier. I spend most of my time obviously looking at deals in New York, but I also have more of a focus in terms of enterprise, the cloud, infrastructure, developer tools, machine learning, things like that. Thanks.
All right, thank you all. So as you see, we have a great panel. We've got larger funds, smaller funds. We've got corporate VC represented. We've got diverse funds. So it's a good mix. So for those who have been to these events before, you'll recognize that we always try to pack in a lot of content, so you get a lot out of your hour, and today will hopefully be no exception. We've divided the topic up into five areas. We're going to talk about sort of the current status and outlook. We're going to talk about investment criteria and process. We'll have a section of general advice for founders. We're going to spend some time talking particularly about diversity, and then we'll have Q&A at the end. So Q&A will largely be at the end. We might take a couple of questions here and there as we go. You can type them in, and I will be Andy will be feeding me questions, which I will read out. I'm guessing we may not get to everyone's questions. Apologies in advance if we can't. We've got a large attendance today. We'll do what we can. We're going to focus on the questions that are of most general applicability. But I believe all the panelists and I myself will be able to stay afterwards for the networking piece. So that would be an opportunity to ask additional questions. So let's jump in. The first topic is, at a high level, what does the VC market look like today? Current status. What does it look like in particular for early stage VC funding? And what do VCs expect to see happening over the coming months? So I made a few observations at the beginning about what the data shows and what it particularly shows for early stage funds. So I guess, Andrea, maybe if you could start off, what are your thoughts in terms of whether you are seeing the pace of VC funding maintaining, and any specific shifts that you're seeing or you're expecting when it comes to deal terms, valuation, and the like?
Yeah, obviously you have to believe the data, but just from anecdotally and how it feels, it really doesn't feel like that. Obviously, I was especially disappointed to see the data about female founders and diverse founders, and I think that's just an area overall where we need to do better, COVID or not. But honestly, this was, I think, the busiest summer we've had, at least in the 6 years that I've been at Lerer Hippeau. We looked at twice the number of companies that we looked at over the same period last year. And we've done 10 new investments since COVID in March, and I think we've done 20 plus kind of follow-on investments in our current portfolio. So it definitely hasn't felt less busy. If anything, it's felt a lot more busy with back-to-back Zoom calls, and but and it's been quantity and quality. Really great, a lot of companies, but also a lot of great companies. So and also valuations have been also as high as they've ever been. So I know the data says something different, but I think anecdotally from my position, it feels like a super hot market. I think a lot, especially at the early stage, people are trying to figure out what are going to be the real changes post-COVID and where to invest around that. And I think there's going to be a lot of companies that are going to be started, that are just starting right now, or going to be started in the next few months, that are also going to be super exciting to look at.
Great, thanks. Simeon, thoughts?
Yeah, just, I would echo comments from Andrea, and I would say, look, it does seem like there's still a hot market here, and I'm very optimistic on the VC landscape. Reality is VC is still going to continue to be one of the highest returning market classes out there. And so there's a lot of money that's going into it, from traditional investors to non-traditional. So if, looking at the stats and the data, funds have raised more money than 2019 already. And then when you talk of deal flow, deals are still getting done. M&A activity is still happening. So I think the market is still strong, COVID or not. Of course, we moved into this new sort of Zoom environment, so that has changed the landscape. But we're seeing deals get done. In my space, in fintech or marketplaces and AI, there's still strong activity as in pre-COVID. We just saw a deal got announced yesterday. Paystack over in Nigeria got bought by Stripe. And so that's an amazing deal to happen during these times. So I feel optimistic about the landscape.
Very good.
Yeah, I would agree with all those sentiments. I mean, I think, this year, again, there's been a tremendous amount of VC capital raised, even with COVID. I think we all felt that slowdown in Q1 as there was a ton of uncertainty. And obviously there's still a lot of uncertainty around COVID, but the markets are functioning. There's a ton of capital available. And so I see deals getting done. I mean, I've done 4 deals during the COVID period, all over Zoom, and it's starting to feel very natural. Like we've just kind of adapted, and I think entrepreneurs obviously have adapted to it. And there are some things I think that we still really miss. We miss a lot of the serendipity and just sort of bumping into entrepreneurs at various events. But we're starting to figure out our ways around that as well. And as well, there's less of a focus on geography. I think that since everyone is on a screen, regardless of whether you're in New York or the West Coast or even internationally, it's democratized a lot of the kind of VC access where, otherwise somebody would have to hop on a plane to take a meeting. All of that's gone. And, maybe that's not reflective in kind of deal numbers in this moment. I think it actually will probably lead to an acceleration, into the fourth quarter and beyond. Obviously, this year is one of those years where I put away my crystal ball in terms of macro, and that can always kind of throw a wrench into the situation. But so far, all indications seem to be the market is operating in a really efficient way.
It's interesting to hear your comments on this because, Andrea, as you say, the data says one thing, but our experience says something else. Because as a VC lawyer, this has been my firm's busiest year as well, and we do early stage deals. And so the data tells me things are slowing down in the early stage space, but what I'm doing every day says otherwise. So I guess it's slowing down somewhere, but not for anyone on this who's part of the session. But I guess that's good news. To pivot to a slightly different question, what sectors do you all see as interesting, that you're taking a close look at over the coming months? Simeon, would you like to lead off on that?
Yeah, sure. So for us at NOEMIS Ventures, fintech is big for us. So we're seeing a lot in the consumer finance space, personal finance, investing, and credit. And when you talk about COVID was a time for people to just take a step back and look at their finances. And the data shows that actually credit scores went up during COVID because people had time. They were spending their money on essential things, and discretionary capital was used to pay down debt. I myself, did the same thing. So we're excited about that side. And then we're also excited about artificial intelligence and machine learning being used in different areas. Fintech being one, but we're also seeing other areas like fashion use it. We have a company that we invested in that is using artificial intelligence to make images and videos shoppable. So essentially, you can be watching a YouTube video and click to see any item of clothing that you see in the video and buy that item of clothing, which is changing the way that we're going to view content going forward. So those are two of the things that are exciting us going forward.
Very good. Erik?
Yeah, I definitely agree that sort of verticalized applications of ML and AI, continue to be really interesting as there are just more and more industries that are being transformed by those technologies, and especially those that, where there's not a ton of data scientists and related kind of individuals being hired. For me, I think I've been really focused on developer tools and developer experience, especially as kind of technical teams are being dispersed across geographies. And, I think even post-COVID, people feel that this sort of remote office is going to be with us for, many years or forever. So looking at tools that sort of support collaboration and, more sort of work in the cloud, that's been really interesting to me as well.
Thanks. Andrea?
Yeah, well, for us, so we've always been big consumer investors and big direct-to-consumer investors, which actually had kind of fallen out of favor the last 2 to 3 years a bit. But with COVID, where we're seeing like a 6-year acceleration in digital. So that's been really exciting for us. It's been exciting for a lot of our portfolio companies, but also it's just an area we've never really stopped investing. So that's definitely a focus for us. And I would say specifically within consumer, a few things. One is vertical marketplaces. So these are marketplaces that were either completely offline before, or were just kind of overlooked by Amazon and the big e-com players. And a lot of them are kind of service oriented as well. Two would be what we're calling the digital self, which is basically all these offline behaviors that are coming online now. So that's everything from, health, community, companionship, people adopting dogs, everything that has kind of shifted in the last few months. And I think a lot of that's here to stay as people realize that there's a lot more you can do digitally. And then the third, and some of this is B2B, is supply chain and logistics. So everything that's kind of powering this new digital world in terms of the pipes. And then two other areas I'll just quickly mention. One is digital health. Obviously, people now are using telehealth in ways that they never did before. And I think people are actually taking control of their own healthcare in a way that they didn't previously. And then the third, which I'm sure is kind of on everyone's radar, is the future of work. And what will the workplace look like, after COVID? Will we all go back to the office? Will we all stay digital? I think most likely is somewhere in between. And what are the tools that'll be necessary to power that?
Got it. Great. Thank you. So let's move on to the second topic, which is changes in investment criteria and the investment process. So I guess the first question is, when it comes to the way that your fund are analyzing a company as an investment opportunity, are you looking at a company different? Are there different metrics that you're focusing on? What is it that matters to you now above all else, and has that changed? Why don't we start with Erik?
Yeah, I would say that our criteria have pretty much remained the same through COVID. I mean, we care deeply about the team and the technology and the market and kind of how well a company's product is set up to attack the market they're going after. I think what's really changed is kind of how we do diligence and meet with companies, and that's obviously all moved to Zoom. And we can, we're not visiting offices and doing coffee meetings and things like that. But in some ways, it's made us a lot more efficient. I can now meet an entire management team in a morning just by setting up a bunch of Zoom calls, whereas that might have involved, previously getting on planes or doing lots of travel around the city. And that's, in some way, it allows us to do diligence in a much deeper way for a company that we might have skipped or, just put off other than in the most kind of large deals. So, while I do not enjoy being in Zoom all day, it certainly has made the due diligence process a lot more efficient. And so in terms of meeting companies as well, we can just take more first meetings because there's more time today because they're not traveling or really doing anything else. And those days will pass at some point, but for the moment, it's made things pretty efficient. And I think what's been trickier is, the kind of social interactions that you might have with an entrepreneur before closing a deal, or you maybe go to dinner or do something else. And obviously we all miss that. But in terms of just being able to build a connection with a founder, it feels very similar. Obviously it was very natural at the beginning of the year, and now having done a number of deals in a virtual way, I think it's something that'll continue even post-COVID.
So Erik, let me ask you sort of a follow-up question. You touched a little bit on process. What about the actually making the connection in the first place? And that's something that I hear from my clients, and that was a question that came up a lot when people registered. It's like people are starting to figure out how to have these meetings and how to pitch online and diligence and all that. But the initial making the connection, with the VC, how has that changed for you?
Yeah, it's a great point. And I think I mentioned this earlier. The thing I really miss the most about COVID times is the serendipity, right? Just bumping into someone at an event or a dinner or whatever else, where you might just have a 5-minute conversation that then kind of leads into you exploring a new area or meeting a new person. And that's obviously a lot harder over, in the virtual world, because everything has to be scheduled, and, your bar might just be a lot higher for a 30-minute Zoom call than for, a 5-minute conversation in the real world. So I don't know that I fully have an answer for that. I think that it's really on both VCs and founders to kind of find new and creative ways to network. I'm relying a lot on our existing portfolio and what my partners are seeing, and certainly, we're close to Google, so what we get out of there. So I think it's much harder to network in this environment, but we all have to try on kind of both ends, and that's going to hopefully lead to a lot more connections. But it's not as easy as just going to an event and bumping into people anymore. And if people have solutions to that, I'm all ears, because I really miss all the serendipity from 2019 and prior years.
Well, let's hope that networking sessions like the one associated with this event are a path forward. But I definitely agree with you. Simeon, thoughts on that question? Sort of investment changes in investment criteria, process, and this thought about how do people find you? How do they connect with you?
Yeah, absolutely. I think Erik touched on it, and I would agree. It's definitely more efficient. The good thing about us is that we've been able to do deals. We did deals previously without meeting the founder in person. And so, the adjustment to this Zoom environment has, not been too much of a culture shock for us. We understand, as Erik pointed out, it's an adjustment for everyone. So we all have to figure out how to be effective in the space. So I would say the criteria has not changed. Maybe doing more Zoom calls are happening, and probably more reference checks, I would say, will go on as part of this process. It is different because in a room, you can feel a founder's energy, you can feel their hustle, you can feel their drive. Not quite the same in Zoom. And so it may take a couple more calls for us to be, comfortable sort of checking that founder bucket and team bucket, essentially. I will say, people have found ways to reach me. It doesn't require a warm introduction. I have invested in companies from inbound. So I get a lot of inbound through my website at nomisventures.com, Crunchbase, or even LinkedIn. LinkedIn is a powerful tool in general. And so I've taken meetings from cold outreach on LinkedIn. So I encourage founders to continue to do that. It's almost impossible to get a warm introduction to everyone on your investor target list. And so I would recommend to founders, continue, if you do it already, continue with the cold outreach because VCs do respond.
Good to know. Good to hear. Andrea?
Yeah, I totally agree with what Simeon and Erik said. I think pre-COVID, I don't know if there was a deal we ever did without meeting the founder in person. Even if it wasn't a New York City company, either we would go there or the founder would come to us. So it definitely took us a few weeks to think through that and say, how are we going to do this? Is it something that we want to do? And then I think we realized that it was a necessity. But everything else in terms of, the kind of founders we're looking for, company metrics, all that, all of that's still the same. I would say we're just probably doing a little bit more founder referencing than we would before, given the fact that you can't meet them in person. As Simeon said, there's a lot you get from an in-person interaction that's kind of lost on Zoom. And then the only other thing I would add is, I was just thinking about maybe that's one of the reasons that kind of the female founder and diverse founders numbers have dipped, because, everything now is so network based, given the fact that there aren't, big events and other ways to interact. And if you don't have that network in place already, it can be really hard to get in touch in front of a VC. At Lerer Hippeau, we are making an effort to let people reach out to us cold and directly, and make sure that someone on the team gets back to them, one way or another, that there's no kind of just black hole that you're, that you're emailing. So I encourage anyone on the call to go to our webpage and email our contact us. I mean, you can obviously reach out to me too, but just trying to make sure that, we kind of have our open for business sign out and are giving people access to us, even if they're not currently in our network.
Thank you for that. Yeah, that's a very good point. That's something that I've heard others talk about, that yes, perhaps one of the reasons for the decline in diversity is that people are retreating to their networks a little bit, perhaps not intentionally or by design, but by necessity, because it's a little bit more difficult to broaden your network under the current circumstances. So yeah, that's obviously something that we all need to work against. So let's move on to our sort of general advice segment. That's to say, some things are easier, some things are harder now. So the question is, how should fund founders be adjusting their efforts, whether in terms of sort of their broad strategy or specific tactics for the way they connect with and pitch to investors, in order to navigate the market as it is now, and to have the best chance of getting funded. I mean, Erik, any specific advice or thoughts for founders?
Yeah, I mean, I think actually I totally agree with Simeon and Andrea that reaching out cold with a well-formed pitch is still a great way to get in touch. I mean, you can do that even if you know no one in a particular ecosystem. That's a great way to get started. And by the way, that doesn't just have to be VCs. That can be other founders or CEOs. And that's, those are great people to add to your network, even if they're not the ones that are writing a check. They can give you feedback. They can tell you, which VCs they like to work with, and you can sort of build on that over time. I think, the thing that's always helpful though, when you're thinking about capital partners, is just do they have a thematic fit with what you're building? If you're building an early stage fintech company, who are investors that are deploying capital in that area? And, I think the more thematic alignment that you have and the more stage alignment that you have with an investor when you reach out, you're just much more likely to get on their radar versus something. And again, like it would be great if every VC was a generalist in every possible space, but by looking at their profile, what's in their portfolio, what are they talking about online, you can usually get a pretty quick sense of whether you're interesting to them or not. And by whittling that down, you can really focus your efforts on, hopefully, a lower number of VCs, but you can have more concentrated outreach and, catch someone's attention. I think the other thing I would say that's always helpful is like looking for, the smartest, most helpful capital. I mean, at the end of the day, you need to fund your company to keep going. So any check is probably good. But once you get past that point, think about, who's going to be able to help you in new and different ways. What are the things that you don't have inside the four walls of your company and your, capital partners can bring to bear? So, many of these things haven't really changed that much during COVID. It's really just, how do you open up those virtual doors and, get those meetings? And I think, again, it's probably some of these new sort of networking techniques we've discussed a little bit, and leveraging that in order to get you in front of the folks that are most likely to be excited about what you're building.
Thank you. Andrea, your thoughts as to changes in strategy or tactics?
Yeah, I totally agree with Erik. I think the fundamentals of pitching are still valid. At the end of the day, pitching is about storytelling. And I think with being virtual and on Zoom, it's even more important because, someone could be looking at the Zoom and then looking at their email 2 seconds later. And so you really need to, from the get-go, have a really great story and kind of a storytelling capability that doesn't necessarily come naturally to everyone, but is definitely a skill that I think, in these times where attention spans are probably even less than they were before, are super important. But overall, I think, just really honing your pitch, but everything else should be more or less the same.
Thanks. Simeon, your thoughts?
Yeah, I would agree with both Andrea and Erik. Fundamentals are the same. I would say the emphasis, given that we just went through COVID and still going through COVID, emphasis should still be on being able to articulate the problem you're solving, the business model, and how your startup is better equipped to tackle the problem compared to other competitors. And then once you do that, it's also about thinking about, if your team, taking a look at your team. So now's the time where COVID made everybody take a step back and take a look at, do we need to pivot? What do we need to add to sort of make sure that we have all the metrics in place to sort of prevent another situation like a COVID or another pandemic. So taking a look at your team, who do I need to add? And then advisory board and so forth. And then once you do that, then like Erik mentioned, it's about going to the right VCs that match and are a fit to what you're doing. Yeah, it's hard. And so, yes, do we wish that everyone was a generalist, but the reality is that they're not. So yeah, cast a wide net as much as possible, but it's better if you focus on the VCs who have invested in your space. But now that we're seeing, given as COVID, there are a lot of strategics out there that are also invested in startups. Google being one of them, PayPal's starting initiatives as well, SoftBank as well. So these are all strategics that are investing in startups. So I would recommend to cast a wide net to those strategics as well.
Simeon, that's a good point. I might throw that one to you. As a corporate VC fund, is your approach to these issues different, or is there the way that people approach you or should approach you different than to these other funds?
Yeah, I mean, well, what I would say is like we don't really think of ourselves as a corporate VC. I mean, it's more, the setup is more of like a single LP fund. I'm paid carry just like everybody else. I don't get any Google stock, so we're not looking for something that's aligned with Google. I mean, I invested in a company last year that sold to Facebook for almost $1 billion, and like that's fine. Like that's totally great. I think we certainly work with other VCs that have more of a strategic bent. And generally, my advice there is just to make sure that there's a long-term alignment. I mean, the last thing that you want is someone on your cap table who's disinterested or even worse, a competitor. Again, that's not who we are. But strategics can be an incredible resource when you're aligned, and can be sort of a nightmare when they're not. So usually, my advice is always to sort of look for that capital a little bit later in a company's lifetime, when things are more certain in terms of your direction and the corporate's direction. But it can be extremely valuable if you find a match there.
Got it. Let's talk about timing, which is always a big issue for these companies that are burning through cash. Are fundings taking longer to close, but on the other hand, a couple of you said things are more efficient. I mean, what is it, time to close similar, different than it was, say, a year ago? Simeon, maybe?
Timing for startup funding, I would say for us, it's been sort of the same. We've been able to do deals in as short of a week or short of 2 weeks. And so that hasn't really changed much. We have our own framework that we use and process in diligence, and that allows us to have conviction to say yes, regardless of who else is in the round. And so we stick to our process. So we're able to do our process pretty quickly.
Okay. Andrea?
Yeah, I would say maybe our process is taking slightly longer, given kind of the extra diligence on the founders that I mentioned before. But I would say that that's days longer, not weeks longer. We are though telling our current portfolio companies, so we invest at the seed stage, so the next step for them would be Series A. And typically we would be telling them at the seed to raise for 18 months of runway. And now we're telling companies to think about what they would need for 24 months of runway. Just kind of as an extra buffer, typically raising a Series A takes about 6 months, from kind of initial combos to all the way to close. But just, making sure that companies have that little bit extra runway so that they have time, A, if something kind of goes awry in the business or they need to pivot, and then B, just in case those later stage rounds take a little bit longer than typical.
Got it. Erik?
Yeah, I would say that kind of, at a high level, the time to close is very similar. And, I agree with Andrea. There are some changes along the way, but it's sort of give and take in terms of the timing of it. I also completely agree there. Yeah, we're seeing early stage companies raise more capital. I mean, sometimes taking more dilution, sometimes the prices are just going up. But certainly I'm seeing a lot more capital coming into companies in these early stage rounds. And it's part of the uncertainty. I mean, we saw that in our own portfolio in Q1 when, everybody was trying to extend runway by whatever means possible, bridge rounds, cutting burn, this and that. So it feels like there's a lot of, fundraising rounds that'll come up in this quarter and next quarter that were, delayed from some point earlier in the year. But at the same time, the early stage rounds that are getting to now seem to be optimizing for more runway. And that's, that's a good thing. It gives you more optionality in terms of when to take the next step in terms of an A or whatever round is next.
Sure. Let's pivot to the diversity segment. We've touched on this a little bit. The fact that early stage activity has been impacted, and particularly diverse founders have been impacted. So the question then is, and in a way, this is really just sort of bridges from the previous topic, advice to founders. But is there a particular advice to founders who are in traditionally underrepresented categories in terms of how they approach the marketplace? Given that they now they've always had headwinds, and now those headwinds are even greater than they were before. What do we say to them? What's the advice? Andrea, you want to lead off?
Sure. I think it's just kind of, echoing what we said earlier, but don't be afraid to reach out to VCs cold, either on LinkedIn or the contact us at their site, or guess someone's email address, which is typically like first name at the firm. I think that people are much more receptive while they're home to taking the time to respond to those messages. I used to kind of say this to groups of female founders that I would talk to. And I think now it's becoming applicable to diverse founders as well, but take advantage of the resources that are there for you. I think that there are more funds now that are focusing on diversity. There are more educational groups and mentorship groups and as much as you can take advantage of those, I think that you should try to use it as to your advantage as much as possible. And just know that, this is really top of mind for a lot of VCs, is how do they invest in more diverse founders? So they want you just as much as you want them. And you should really go into those conversations with a lot of confidence in yourself and your idea. And don't be afraid to A, reach out, and then B, really give a great pitch with, and with your background and everything that comes along with it. So I hope that we see those numbers hopefully turn around in Q4 and continuing into next year.
Absolutely. Simeon, your thoughts?
Yeah, Andrea touched on it in the beginning. The numbers are terrible, right? And so the good thing now is that it's no longer an elephant in the room. We're all aware that the numbers are bad as far as funding going to minority and female founders. And so I would echo what Andrea says is continue to drive towards sales, towards traction. Again, at the end of the day, one thing that we have to remember is that high-performing companies today are led by female founders and founders of color. And so we have invested at NOEMIS Ventures. We've invested in female founders who have went on to exit their companies and get acquired by billion-dollar companies. We have invested in Black founders who have gone on to raise a Series B and so forth. So there are high-performing companies led by these founders. And so continue to drive towards proving that your problem and your solution is the right solution for the problem. Continue to drive this so that you can get to sales, you can get to revenue, you can get to strong revenue growth, and you can get to profitability. And then the goal is we hope that the numbers will change. And there is a growing number of emerging managers. And so, you have VC Guide that just recently produced a list of emerging managers. I would recommend all founders to take a look at that. There's a growing number of fund managers who are focused on these demographics, women-led funds and minority-led funds. And so cast a wide net, but continue to go to the VCs who lack diversity today, because the goal is hopefully that they will continue to increase their numbers of investment in diverse founders. And so now you also have, indicators out there like Crunchbase that now has a diversity score indicator that is hopefully going to keep VCs accountable of increasing the presence.
Absolutely. Erik, your thoughts?
Yeah, I completely agree with all of that. I think, at GV, diversity and impact of a company, it's a huge focus. It's something we think very carefully about as we evaluate any opportunity. I also think this is one of these things where the advice is really to the VCs to expand our own networks and hire more diversity onto existing partnerships, because that's part of the way that things are going to change. I love the idea of working with both existing and emerging managers. One of my former colleagues, Lo Tony, he runs a fund of funds that invests specifically in diverse emerging managers. And, we've partnered with him to look at a bunch of the deal flow that comes out of these very early stage companies. Because often the trickiest part is getting the first check. And then there's a ton of other VC capital that kind of pours in once you've crossed that chasm. So yeah, my advice is, do all these things, feel free to reach out. There's even if the timing's not right, figure out what resources you need in order to get to that next step. Because I think, really the hardest point has been some of these initial checks. And once you're past that, you're sort of on the radar of a bunch of different VCs. So it's really about getting over that initial kind of funding, showing that you're kind of a venture-backed startup, and then things take off. So do whatever you need to do to sort of get to that point.
Got it. So we're going to pivot to our Q&A. We've got some questions coming in, and feel free to pass them along. And I've got questions that came in the registration process. One question, what do you think about bootstrapping versus raising more and longer runway? Whoever would like to pick that one up.
Yeah, I'll start on that. I would say if you can bootstrap, if you have the ability to bootstrap, I found that many of the founders that we invested in were able to bootstrap to get themselves to a point where they started to earn sort of 15 to 20 to 30K in monthly recurring revenue. That gave them enough runway in addition to the sales that gave them almost 18 months or 24 months before they were able to raise sort of their bigger round. So I would encourage that if you have the ability, understanding that it's hard to bootstrap, but if you have the ability to do that, I would highly recommend that.
Erik, Andrea, jump in?
Yeah. Oh, sorry. Go ahead, Erik.
Oh, no, I was going to say, I completely agree. Bootstrapping is super hard to do. It shows a level of tenacity that, not every entrepreneur has. So I think if you're able to, build any kind of sustainable business from scratch, that's hugely impressive. And what's interesting is that at some point along that road of bootstrapping, you're going to figure out that there's a very obvious need for capital and how that just helps you grow even faster. And that's the best pitch. Every VC, when they see something come in and it's very obvious that adding capital into the business is just going to immediately result in more growth, that's the easiest check to lever right. And so, we love seeing those types of bootstraps done. It's certainly not possible for every business out there. But if you're willing to put in the work and do it, it's great. And frankly, it usually ends up with you owning more of the business.
Absolutely. Andrea, any other thoughts?
Yeah, I was just going to say exactly what Erik said, so I'll keep it brief. But yeah, don't raise just for raising sake. I think sometimes people start a business and they think, okay, now I go raise money. I mean, you need to be really intentional about it. And as Erik said, that's a lot more appealing to a VC when you say, hey, we need $2 million and it's for XYZ, and that's like the best case scenario. And then also I think it gives you a little bit of time to figure out like if raising VC is even right for you. I think there's a lot of businesses out there that aren't right for venture capital. Unfortunately, there's not as many kind of funding options available for startups. I wish that there were more grants and other ways for companies to get funded. But taking on VC money is a big decision as a founder, and should be one that's taken lightly. So, as far as you can get kind of without it, and then see, okay, we really need to accelerate growth in these areas. I think that's the best way to go about it.
Something I'll just throw in here. I often, always say to my clients where it's appropriate to think about vendor financing or customer financing, because for the right company, there can be opportunities with their partners, whether it's a vendor or a big customer, where they may be able to get financing on very attractive terms. Another question. So here's a timely one. What do you regard as a likely impact of the election coming up? Whichever way it goes, or regardless of which way it goes, who'd like to make a go at that one?
I can kick it off. I think for us, there's no impact. I mean, we're investing in companies with a 10-year investment horizon, so there could be 2 more presidents before that company exits. I don't think any candidate is running on any sort of platform that's kind of either here or there for a startup company. Obviously, there's bigger kind of geopolitical issues for different markets, but I think in terms of like day-to-day operations, it'll be business as usual for us.
Erik, Simeon, would you like to add in anything on that?
Yeah, I've kind of put away my crystal ball for these types of things after this year. Certainly, I think there's a lot of other macroeconomic factors that could come into play. As Andrea mentions, like a lot of these VC relationships are a decade. So many different things can change over that. So I think it's a mistake to over-index on one event, even though it'll certainly be important for many, many different reasons.
Indeed. Simeon?
Yeah, I would agree with that. It's uncertain to determine what will happen due to the election, either side. All we can say is, look, no change for us. It's not going to change the number of investments that we make. It's not going to change how we do business and how we support founders. And so, yeah, it's not really in our focus. Understanding, just like Andrea and Erik mentioned, there's going to be macroeconomic factors that are going to affect some industries and regulation that could affect some industries. But other than that, it's business as usual. It's already been a crazy year, and COVID has already impacted the way we look at sort of tech and startups and the VC landscape, as in addition to some of the other stuff that has been happening with the social injustice. So I think those 2 alone has impacted the year for startups and VC. And the election we're still uncertain about that.
So it is. Another question that's come in. What are the characteristics and personality traits of successful founders? Anyone want to take a go at that one?
Yeah, I can kick it off. I would say there isn't one blueprint. I would say as I look at all the founders that I invested in, I think some of the common themes where there was this hustle and this grind that my founders had, their ability to sort of get traction, with very minimal resources. their ability to get pilots. I had one founder that their business is built on using 3D knitting machines for the knitwear industry. They were able to get a company to donate them 3D knitting machines. Now, if we're going to talk about hustle and being driven to be able to make something like that happen, this is what we look for in founders. And that goes into what Andrea was saying about your story. Understanding your story is big in telling us, potentially what you could possibly do and take this company to that next level.
Got it. Erik or Andrea?
Sure. Yeah, I completely agree with that. And look, founders come in all shapes and sizes and different levels of experience. It's really hard to generalize. I mean, maybe one thing that I think is pretty common is courage. Like starting a early stage company is very difficult. The odds are stacked against you. Your competitors have more money, more people, more time in the market. And so that's something that's kind of universal, but it's also not something that necessarily comes up in a quick due diligence kind of turn. So it is something that's very important, but there's a lot of other attributes that go into being a successful founder.
Got it. Andrea?
Yeah, a couple of things. I mean, I think, founder market fit for what you're building is really important. If you really understand the market that you're building in, you can kind of weather the storms. And I think that was proven with COVID. Like the more the founder really knew their market and not that they could look at a crystal ball, but they were better able to predict how, things might play out. And then I think, adaptability and tenacity is another kind of lesson we've all learned this past year. Obviously visionary founders are amazing, but how you also need to be able to be humble and say, okay, this isn't working out, or this market totally changed on us, and able to kind of adapt and pivot the company in small ways and in big ways to weather it.
All right. Well, we're gonna sort of wrap up with some final thoughts now. Simeon, any sort of last words of wisdom for the attendees?
Yeah, sure. I think, again, like we mentioned on the call, just do your best. We understand it's hard for many people that are starting their startups and trying to grow it. So reach out, and we're accessible. I'm accessible. Do the cold outreach. Do what you can to build the right people around you, whether it's advisory board or the team with complementary skill set. It's really going to be helpful in taking you to that point where you're going to raise a Series A and a Series B and then eventually exit. But yeah, reach out and don't be afraid to reach out.
Thanks. Andrea?
Yeah, I guess, two things I think I kind of took away from this conversation myself. For one, like, don't let the data discourage you. It seems like us on the ground are having maybe a little bit of a different experience. So, don't think that you can't get funded. And then two, just don't be afraid of cold outreach. I think now more than ever, it's important. And you should never feel like ashamed or uncomfortable that you can't get to someone through a connection. Just do the cold outreach, and you'll never know unless you try.
So it is. Erik?
Yeah, I agree with both of those. The thing I would say is take a long-term perspective. I think especially in this year when we've had so many changes so quickly, it's easy to think that things will remain the same or in this sort of state forever. And, I think having long-term thinking, COVID will go away at some point, will just help you build a business that's really going to be around for the long term.
All right. So we're almost out of time. So first of all, thanks to the three of you, Simeon, Andrea, Erik. Really great conversation. A lot of, I certainly picked up some interesting thoughts through this. I would, thanks to all the attendees. Do stay around for our networking session. If we didn't get your question answered, there will be an opportunity to sit down at a virtual table with the panelists and with myself. Keep your eye open for the video. We will be circulating this video, which you can pass on to your friends and colleagues. And remember our upcoming events that Andy noted. Again, November 20, we have our session on exits by acquisition, which should certainly be a good event. We look forward to that one. Beyond that, again, thank you to all of our panelists. Thank you to Andy. Thank you for the participants. And we hope we'll see a bunch of you in the networking session. Have a good afternoon.
Thank you.